So let's start with the first chapter, which is trend, the basics. What is a trend? Trend is a directional movement. You may have heard words like uptrend, downtrend, or trending markets. This is basically a market or prices moving in a particular direction, either upwards or downwards, or just flat. So that's the trend. The profit can be generated from trend if we follow just three simple steps, and it's very simple at a very basic level. First is to be able to determine the trend when it has begun with minimal risk of error. So that is most reliably being able to predict and understand when a trend has begun. People, the traders who can do it at earliest in the sense of time and in the sense of price, from price movement, they will have a added advantage here. Second step is to select and enter position in the trend that is appropriate for entering into an existing trend. So it could be an uptrend or a downtrend. We have to be pretty comfortable and confident about entering into a position. So being able to select a position and enter a position in the trend regardless of the direction, up or down, whichever it is. And third step is to close the position near the end of the trend, right before the trend is about to end or reverse. So if the stock prices are going up, they are going to stop going up sometime. They could either move sideways or they could come down momentarily or at a more serious pace. So to be able to profit from trend analysis, you need to know when to enter and you need to know when to exit, and you need to do that before the market catches up. What I mean by market catching up, that is before the trend moving too high for you to profit from that or to make a good fortune from there. For example, if prices were trending in this direction and suddenly they start going up, and this is a very basic trend, we're not looking at it from an analysis perspective, but whether the prices have started moving up here or here or here, or they move up here like this and then just suddenly crash, so or here or here, that is the skill of the technical analyst. If you are entering here, you may not be in profit for a long time, and you would probably get out of the trend, get out of the trade without making any profit, but still experiencing some transaction cost. If you are entering into trend here but exiting here, right between this range, you recognize the pattern correctly, but we're not able to maximize the profits because the price moved from here until, let's say, this point. So you could have made more profit if you had just stayed there. But how do you know whether to exit here or whether to enter here and wait for 2 periods, wait till this much period, expecting the profit to go down, to increase? Like if you follow the trend from here to here, right, from these 2 points, and enter at this position, then your profit, you are very certain that the trend is upward here, but your profit potential is very very small because most of the growth in share price has already happened. So entering into a position first, being able to recognize a trend, entering into a position, and then exiting it on time, these all three things are extremely important from a trend analysis perspective. Right now, this is upward trend because this part is a downward trend, right? This part is downward trend, and this part, as it is seen, or rather this part to be more specific, when prices are not moving, increasing or decreasing substantially over a period of time, that is called as a sideways trend or neutral trend. So we'll have these concepts clear in our mind, and then we'll move forward. We'll first understand some basics of trend. Actually, let me just clear this area altogether, and then we'll look at some basics. So First thing that we have to keep in mind that trends are fractals. Now, what are fractals? Before explaining to you fractals, I'll give you an example of how it is applied. Now, all of us have seen those animated films by Pixar. We have seen those flight simulations where the rendering, now if you compare the rendering before Pixar became very popular, maybe 15 years ago, the scenery, the background was recognizably virtual. People could see that it's not a real picture, it is made up of graphics, and if you zoom in close enough, you will see the graphics being distorted. But with Pixar coming in, they developed technology in such a way that even at a very zoomed in level or a zoomed out level, your graphics, your background, your rendering was so realistic that you could not believe that these are virtual images. This is animation and not a real life scene. You have not shot this picture somewhere else in a real location and then put it there. How did they do it? They used fractals, they used these triangles. You can see the image here, the mountain ranges here are kind of divided into triangles. So each scene, each frame is composed of these triangles which can extend up to infinity. So no matter whatever your zoom in level or zoom out level is, you're still seeing the same pattern. Same way with trends, it doesn't matter where you're looking at an hourly trend or a minute by minute trend or trade by trade trend or a daily trend, and you're looking at a trend over a 6 month period or 5 year period, you'll still find the pattern in the same manner. You'll still find the trends in the same manner. There are of course minor differences because of the trades happening, so rounding off and granularity of information. But prima facie, if you've been given a trend, you would not be able to recognize whether it's a minute by minute trend or end of day close trend just by looking at it if you're not given with the axis, right, with the horizontal axis or the time frame, right? So that is the idea of fractals. Interesting concept not only for trend analysis but also from the new developments in the computers and graphics area. Now trends have time periods. So as I said, you wouldn't know whether the trend, a particular graph is given for a day or an hour or a year unless you've been given a time period. So there are three time period as Dow had defined them. He had defined them as tides, waves, and ripples. We call them in current language as primary, intermediate, and minor. So as you can decipher for the name, tides are more over a longer period. So over a slightly longer period of trading area. Minor or ripples are very short. At least in Dow's time, he could not recognize the pattern or a trend and benefit from it or profit from it. Intermediate time horizon is somewhere in between. So there is no standard period where minor time period ends and intermediate starts, or where intermediate ends and primary time period starts, but it's more or less a relative term, right? So these are the time horizons. Another aspect which rather goes against the classical efficient market hypothesis is that trends tend to continue rather than reverse. This is more dependent on psychology of the investor or behavioral finance, behavioral aspect of the investing. People, when they recognize the prices are increasing, they want to be part of that trend. They want to be on the confirming side. Very few individuals, very few institutions would be willing to take a stand opposite to the continual trend, to the existing trend. And even if they do take a stand, they would not be large enough to reverse the trend as a single entity or a single trader. Right? Trends tend to continue moreover from the sheer momentum and the behavior of the traders rather than the reverse, and that's the exact reason why efficient market hypothesis does not apply here and why we can profit from the trends. Another point that we should keep in mind that any particular trend is influenced by the next larger and the next smaller trend. Now what do we mean? Obviously you can make it you can be very specific about how a trend is influenced by the previous larger or smaller trend, But in technical analysis, we assume that any trend is influenced by the next larger and smaller trend. Right? So the cause and effect is vice versa. We will understand this concept better as we take the examples of trend analysis. But for now, what we will understand, what we'll keep in mind as the longer the trend will influence the strength of the trend interest. What it means is strength of the trend is how much trend is continuing, if it's an uptrend, whether it is gradually increasing or whether it is increasing quite dramatically, and how is the volume supporting that uptrend or a downtrend on the other side. Strength and length of the trend will influence the next trends. How strong and long the previous trend was will influence the next trend, whether small or large. Longer persistence of the trend or higher the volume supporting the trend, more would be the influence on the next trend, and vice versa. So if you look at it, if you try to link it to our time periods, short term trend will not reverse or turn, as it is called, earlier than the intermediate term trend, and intermediate term trend will reverse or turn earlier than the primary trend. Right? So this is something that we have to keep in mind. Another point that we have to keep in mind as trends are influenced by mass psychology. This is what we call as behavioral finance, behavioral trading. Now what happens is the psychology works as a positive feedback mechanism in our mind, right? And this is a collective mentality that I'm talking about. For example, in an uptrend, buyers who have profited, in the earlier example, the graph that we had drawn some time ago, buyers who had entered early and exited early may still see the trend continuing and may either continue holding their position or enter again to benefit from the continual upside. On the other hand, people who missed the trend or missed catching the trend at the earlier stage would then try to benefit from it by entering later in the time. Right? So there will be new buyers continually being able to and being willing to purchase at a higher price. So over a longer period, the prices tend to continue. Right? They tend to follow the momentum, carry the momentum until some event, some resistance, some internal external trigger causes the prices or the trend to reverse. So these are some of the basics that we have to keep in mind. Keeping these ideas in mind, we'll straight away start looking at some examples and try to understand the terminologies better.